Hello and welcome to this week's Ferrari Financial US market news summary. Well, investors left for the Labor Day holiday weekend in quite good spirits. The whole week was more buoyant for the markets than of late. There was quite a down day on Tuesday, however, when the market, in anticipation of the Fed chairman's upcoming comments, did sell off to some degree. But from that point on, the market recovered quite nicely for the rest of the week, in fact closing the week higher than the previous week, particularly bolstered on Friday by President Bush's comments regarding the subprime mortgage situation. Will this really be enough, though, to allay investors' fears over the whole financial sector? Let's take a look at our chart and discuss three scenarios. We're going to take a look at the one-year chart for the Nasdaq Composite Index because I want to focus in more close-up detail on the sell-off feature that we've had since the middle of July, when, as we predicted, the market did top off and has been falling really ever since, except for a small bounce it took off the short-term moving average line, which is this line here, and you can see this little bounce back that happened last week. The Friday rally that we had on the Fed news of cutting 0.5% off the discount rate has brought us back to this level here. But I want to show you three scenarios really on the chart. The first is a nice simple one, which is that we would draw a trend line, short-term trend line, cutting through these last 3 points really where the market took a bounce. And you can see how the market has returned each time from the short-term trend line. It attempted to again last week but failed, and the significant penetration down to just under 2,400 indicates to us that the likelihood that the market will continue to follow this trend line upwards is quite low. Our second scenario really is more probable, and that is that we've established probably a barrier range or a channel range between this level here, which is where the market went up to last week before deciding to turn south again, and the level that it bounced back from on Thursday night, which is this level here, which was actually 2,380. And this channel range here is quite a wide trading range that the market could well stay within for the next few weeks. The last scenario is probably the worst of the three, because even though I don't show it going back a lot further, over the last 3 years a much longer term trend line has been established, which again passes through this point but is a much shallower line, and if I was to extend it back and then forward extrapolate it to this point here, it would actually touch the scale, the price scale, at around about 2,100. Now we do feel that a right shoulder could be forming here over the next few weeks, maybe within this channel that we've established, and then there could be the inevitable penetration of the 2,400 line that was established this week. And then the next stopping point, in our view, would probably be down to this trend line here at just over 2,200. So we'll keep a very close watch on the markets in the next few weeks to see which of these scenarios looks like is unfolding. But certainly our best guess at the moment is some more consolidation within the channel line that's been established here, with the possibility of the head and shoulders scenario forming with a right shoulder out here, and then a drop down past the 2,400 down to as low as 2,200. So when traders return on Tuesday, after the Labor Day holiday weekend, there will be a lot of important economic news to digest this week. On Tuesday itself, there's the U.S. manufacturing figures, and although they're expected to weaken slightly, a surprise in this figure will certainly cause investors to pause again. On Wednesday, the Fed's Beige Book will come out, where the economic activity in the different regions of the country will be reported on, a very important indicator. Plus, the National Association of Realtors will report on pending sales of existing homes. The investors will be looking for better news from the housing market. But I feel the important news needs to come from the Federal Reserve. The market is really looking for Bernanke to keep to his promise, or certainly his indication, that the Fed would consider now cutting the Fed funds rate. I feel the market has already priced in a 1/4 percentage point at the September meeting, and probably another 1/4% in the October meeting as well. I think the market will be disappointed with anything less and show their disappointment in the normal way. So we're still possibility of a sharp leg down still to come. We'll be watching for this very important news to break. Until then, it's goodbye from London.